The short-term rental factor. Short-term rentals have become a defining feature of the new luxury housing market. Developers increasingly design apartment buildings with the specific intent of catering to the short-term rental market, especially in cities where tourism drives high demand. Instead of focusing on long-term residents, many new projects incorporate features like keyless entry systems, industrial laundry rooms, and flexible layouts that are better suited for rotating guests than permanent tenants. According to recent research from the National Association of Realtors, cities across the country are seeing a noticeable uptick in luxury condos and apartments being converted to short-term rentals, particularly in neighborhoods close to business districts and entertainment hubs. This shift is not just a response to consumer preferences, but a strategic financial decision. Luxury units can command higher nightly rates on platforms like Airbnb and VRBO, often generating more revenue in a month than a traditional lease would bring in. While the costs associated with frequent turnover and platform fees are higher, the potential for increased income makes the short-term rental model attractive to developers and investors alike. In tourist-heavy markets like Miami, Las Vegas, and Orlando, this approach has become so widespread that entire buildings are marketed to institutional buyers as STR-ready, with amenities and management structures designed to support a steady flow of short-term guests. The consequences for local housing markets are significant. Every unit dedicated to short-term rental is one less home available for long-term residents, further tightening the already limited supply of affordable housing. Even though these buildings are technically classified as residential, their actual use as de facto hotels distorts housing inventory statistics and masks the true extent of the shortage. As noted in recent background research, this strategy reduces the number of available homes and drives up rents for everyone else, especially in cities where workforce housing is already scarce. Zoning laws have not kept pace with this trend. Most cities still draw a clear line between residential and commercial uses on paper, but few have regulations that address the hybrid nature of these new developments. Developers take advantage of this legal gray area by obtaining residential permits and then partnering with property management companies that specialize in short-term rentals. As a result, buildings that appear in official records as apartments may, in practice, operate almost entirely as hotels. In some cases, developers even dedicate entire floors to furnished units with hotel-style services, further blurring the distinction between housing and hospitality. Municipal governments face real challenges in tracking and regulating these conversions. Many booking platforms resist sharing detailed data with city officials, making it difficult to assess how much of the local housing stock has shifted to short-term use. While some cities have attempted to cap the number of STRs or require minimum lease terms, developers often find ways to work around these rules, such as offering 30-day minimum stays that still exclude most long-term residents. The financial incentives driving this trend extend all the way back to project financing. Lenders increasingly offer favorable terms to developments that can demonstrate strong potential for short-term rental income. This has led to a feedback loop, where more new construction is designed with the flexibility to serve either tourists or residents, depending on which is more profitable at any given time. For neighborhoods, the impact is clear. Rents for traditional apartments tend to rise in areas with high concentrations of short-term rentals, and the constant turnover of guests can strain building maintenance and disrupt community stability. Residents often face increased noise, security concerns, and a sense of impermanence as their buildings fill with visitors rather than neighbors. The growing prevalence of short-term rental conversions is shaping not only what gets built, but also who can afford to live in the city. As developers and investors chase higher returns from temporary guests, fewer units remain available for people who need stable, long-term housing. The result is a market that prioritizes flexibility and profit over permanence and affordability. This evolution in building use is also influencing the broader construction industry. The demand for short-term rental, friendly amenities, and rapid turnover services is changing the types of skills and labor needed on job sites, further complicating efforts to address the shortage of affordable homes.